The Clarity Act might get its Senate moment this week. Odds are not looking good. Recent estimates from Galaxy Research have dropped as low as 30% for passage in 2026, citing the tight calendar before the August recess, the need for 60 votes, and lingering Democratic concerns on ethics and other provisions. If the bill stalls or fails to advance, what happens next for crypto? Short-term sentiment hit is likely, but failure does not equal industry collapse. Bitcoin and the broader market have lived through far worse uncertainty. Today I'm walking through a practical checklist of tokens and categories that tend to be more resilient when U.S. market structure legislation stalls. Why some assets are less dependent on this particular bill, and how to think about positioning without turning a legislative setback into an emotional trade. You are watching the Signal and Noise podcast. Make sure to like and subscribe as we analyze with no emotions or bias. Just raw data analysis pointing towards the signal and dispelling the noise. This is not financial advice. Do your own research. Let's get into the real picture. As of late July 2026, the combined Senate text is out. The bill has cleared committee hurdles earlier, but floor time is the bottleneck. Republicans hold a majority but need roughly 7 Democratic votes for cloture. Ethics language and other sticking points remain. Galaxy and prediction markets have steadily lowered odds as the August recess approaches. A vote or meaningful procedural move this week is still possible, but the path is narrow. Delay into the fall or next year is the base case many are now pricing. Important correction. Fails this week does not mean the bill is dead forever. It can return later. What it does mean is prolonged regulatory uncertainty, continued reliance on agency interpretation, enforcement actions, and court cases instead of clear statutory rules. Regulatory disappointments often trigger a sentiment-driven sell-off of 10 to 30% in the more narrative-sensitive assets, followed by a dig for fundamentals. Bitcoin has proven relatively resilient because its commodity treatment is already widely accepted. Assets most exposed to the Clarity Premium, those whose legal classification or U.S. institutional access the bill would settle more cleanly, can see sharper short-term pressure. Exchange tokens, certain altcoins with heavy U.S. retail or ETF narrative, and pure speculative plays tend to feel it more. Longer term, the industry keeps building. Institutional infrastructure, ETFs that already exist, tokenized products, DeFi protocols with real revenue continues. Failure removes a potential catalyst but does not erase underlying adoption, technology progress, or global demand. Instead of a simple buy these if it fails list, use a filter. 1. Clear or widely accepted commodity-like status already. 2. Strong non-US demand and usage. 3. Real utility and revenue generation that does not require US retail trading volume. 4. High throughput or infrastructure role that benefits from global activity regardless of one jurisdiction's rules. 5. Lower reliance on imminent US ETF or classification catalysts. This is not financial advice. Past resilience does not guarantee future performance. Position sizing and risk management still rule. Here's a balanced, category-based checklist for assets that historically show relative resilience or clearer fundamental demand when U.S. market structure bills stall. Tier 1, highest relative resilience, Bitcoin, BTC, already treated as a commodity by major regulators. ETF market is live and substantial. Global store of value narrative does not hinge on this bill. Ethereum, ETH, strong commodity arguments, deep DeFi and staking utility, large institutional and international footprint. L2 ecosystem continues regardless. Tier 2, utility and throughput focused, Solana, SOL, and other high-performance L1s, with proven real-world usage, developer activity, and non-US volume. Throughput and consumer/enterprise applications provide demand independent of one US bill. Established DeFi protocols with consistent fee revenue. Examples in past analyses have included leading DEX and lending protocols. Real cash flow generation matters more. Tier 3, selective infrastructure and international plays. Tokens tied to networks with strong enterprise RWA or cross-border payment traction. Assets with existing international listings, ETF products in other jurisdictions, or clear commodity profiles. Avoid or size carefully pure meme or narrative tokens whose primary near-term story was Clarity unlocks US capital. Those can reprice hardest when the catalyst is delayed. Expect volatility and possible underperformance in the most US regulation-sensitive names. Do not confuse a sentiment flush with a permanent impairment of technology or adoption. Focus on projects that keep shipping, generating revenue, and attracting users globally. Regulatory clarity is a tailwind, not the only driver. The industry has operated under uncertainty for years. Codified rules would be better. But the absence of this bill does not stop Bitcoin's properties or Ethereum's settlement role. Diversify across the resilience tiers. Keep dry powder for forced selling. And reevaluate only on actual fundamental changes, not just legislative headlines. Macro factors, rates, liquidity, risk appetite, often dominate crypto price action more than any single bill. Always size positions you can hold through volatility. The Clarity Act faces a tough path this week. Odds have declined. This is scenario planning, not a prediction. Manage risk. Stay focused on fundamentals. If you want more legislative updates and balanced breakdowns, subscribe and hit the bell. This is Signal and Noise. Legislation matters, but technology and adoption matter more. Stay sharp. Stay updated.